Welcome to Talk Tickers. Today we are unpacking a headline that really sent a jolt through the fintech sector.
The big one.
We're looking at Enova International, ticker ENVA. They've entered a definitive agreement to acquire Grasshopper Bank Corp, and with it, Grasshopper Bank.
It's a massive move. And we're talking about a deal valued at approximately $369 million. But if you just look at that price tag, you are totally missing the big picture.
Oh, completely.
This isn't just an acquisition. It's a fundamental shift. They are moving from that old, rent-to-charter model to owning the absolute crown jewel of the financial world.
A national bank charter.
The crown jewel.
Exactly. And that is what we are going to tear apart today.
Uh-huh.
We need to look at the deal mechanics. Sure.
The cash, the stock, all that.
Right. But then we have to get into the weeds on why this matters.
Yeah.
We're talking about a massive drop in funding costs, the regulatory moat it creates.
Especially against new state laws like that Texas HB 700.
Yes. And we have to address the elephant in the room, the Cantero Supreme Court decision.
And of course, stick around for the end. We've got our This Is Not Financial Advice segment. I'm pitching a trade idea that I'm calling the regulatory arbitrage long.
I like the sound of that. Okay,
Yeah.
So let's unpack this. Start us off with this snapshot. What are the nuts and bolts of this transaction?
All right, so as you said, the value is around $369 million. Structurally, it's a 50-50 split.
Cash and stock.
Yep, 50% cash, 50% newly issued shares. And when the dust settles, Enova stockholders will own 94.7% of the whole thing. Grasshopper stockholders get the remaining 5.3%.
And the valuation metric. Because buying a bank right now, it's not cheap.
It is not. The deal is priced at approximately 2.54 times tangible book value.
Whoa.
Yeah. And for value investors out there, that might sound steep. Regional banks often trade closer to, 1.2, 1.5 times book?
Exactly. So paying over 2.5 times is a significant premium.
It's a huge premium. It implies they aren't just buying Grasshopper's current loan book. They are paying a scarcity premium. They are paying for the license itself.
Right, that charter.
In this regulatory environment, a clean, digitally native national bank charter is one of the rarest assets you can find. You pay up for that access.
And the timeline for this closing?
It's a ways out, second half of 2026, which, accounts for the regulatory gauntlet they have to run with the OCC and the Fed.
Makes sense. And there's a big leadership shuffle happening, too, which signals how serious they are about this.
Absolutely. David Fisher, the current Enova CEO, moves to executive chairman. Steve Cunningham, the CFO, is stepping up as CEO of Enova.
And the bank itself.
That's the key. Cunningham will also be CEO of the bank's subsidiary. Mike Butler from Grasshopper stays on as president of the bank, so you get some continuity.
But Enova leadership is taking direct control.
Exactly. Which regulators want to see. They want to know the buck stops with someone who gets the compliance landscape.
Okay, so that's the what. Now let's get into the why. Because Enova has been a successful non-bank lender for a long time. Why the headache of becoming a bank now?
It brings us back to the old Willie Sutton rule. Why do you rob banks?
Because that's where the money is.
And in the fintech world, why do you become a bank? Because that's where the low-cost deposits are.
It's the cost of capital. Simple as that.
Precisely. If you're a non-bank lender, think about how you get your cash. You're using warehouse lines of credit, securitizations, maybe high-yield corporate debt.
All of which are expensive.
Extremely expensive,
Right.
Especially now. You're paying a spread over the benchmark rate. It's volatile.
Whereas if you're a bank,
You fund your loans with deposits, and Grasshopper brings about $3 billion in deposits to the table. They're sticky and generally so much cheaper than Wall Street debt.
okay, so let's quantify that. What's the actual impact on the spreadsheet?
Enova expects its cost of funds to drop by over 200 basis points.
Wow.
Yeah, they're going from roughly an 8% cost of debt to around 6%. When you are originating billions in loans, saving 2% on every single dollar you lend is massive.
That's just pure margin expansion.
It's pure profit. We're talking potential funding synergies of $50 to $150 million in the first 3 years. That alone justifies the premium they paid.
Okay, but here's where it gets really interesting for me.
Yeah.
Why buy Grasshopper? Why not just apply for a charter and build it yourself?
You can try.
Right? We've seen others try.
And you will likely fail. The regulatory environment for de novo for new fintech charters has been brutal. Just brutal.
We saw this play out recently with the GM versus Thraven dynamic, didn't we?
That is the perfect case study. You had General Motors trying to get an ILC charter for their auto loan business. Makes total sense on paper.
But they hit a brick wall.
They eventually withdrew the application, almost certainly due to regulatory pressure. The FDIC is terrified of commercial firms mixing with banking. They see it as a systemic risk.
But Thrivent got approved.
Thrivent did. But the key is, their proposed bank looked like a traditional community bank. It was safe. It was, boring.
And regulators like boring.
Regulators love boring.
And Enova is not boring.
Enova is a high-velocity, algorithm-driven lender. If a company like that walks into the OCC and says, we want to start a bank, it sets off every alarm bell in the building.
So if you can't build it because they won't let you in the front door,
you have to buy a ticket. M&A is currently the only viable path. You find a bank already in good standing, like Grasshopper, and you acquire it. It's buying your way in.
Let's talk about what they're actually buying then. We mentioned deposits, but there's something even more valuable attached to that charter: preemption.
This is the real crown jewel. A national bank charter offers federal preemption. It means the bank operates under federal rules, not 50 separate state licensing regimes.
Which is a huge deal for efficiency.
Oh, huge. And for a lender, this connects directly to rate exportation.
Explain that for our listeners.
Rate exportation lets a national bank charge interest rates based on the laws of its home state, not the state where the borrower lives.
So if Grasshopper is based in a state with favorable lending laws, Enova can lend to a customer in a state with stricter caps, but charge the rates permitted by Grasshopper's home state.
Correct. For a national lender, especially in the near prime space, this is absolutely critical. It simplifies everything.
However, we have to address the shadow hanging over this, the Cantero decision.
Right. Cantero v. Bank of America. This is the nuance that keeps bank lawyers awake at night.
So it's not a blanket protection anymore.
It's less automatic. The Supreme Court basically kicked the can down the road. They said courts need to conduct hearings to see if a state law significantly interferes with the bank's powers.
So it introduces litigation risk.
Yeah.
You might have to fight for your preemption.
You might. It tarnishes the crown jewel a little bit.
But, and this is but even a slightly tarnished crown is better than wearing a tinfoil hat in the rain.
That's the calculation. That is exactly the calculation. Owning the charter is still vastly superior to being a non-bank lender in this climate.
Okay, let's pivot to the financials quickly. Investors love this news. The stock popped. Why?
It's the accretion. Enova is projecting greater than 15% adjusted EPS accretion in year one.
15%.
And greater than 25% once it's fully integrated. Those are massive numbers for an acquisition.
Usually with big M&A, you see a dip at first from integration costs.
Right, but because the cost of fund savings kick in so quickly, the math just works immediately. You swap expensive warehouse lines with those cheap deposits, and the savings drop straight to the bottom line.
Now, let's connect this to that state-level threat we mentioned. Talk to me about Texas HB 700.
This is a fascinating development. States like Texas, California, Utah, they're cracking down on non-bank commercial lenders.
What does that actually look like?
It's a nightmare for speed.
Yeah?
Texas HB 700 requires extensive disclosures, but more importantly, it has these provisions about liens.
Liens.
For a non-bank lender to use ACH debits for payments, some of these new rules require them to hold a first priority perfected security interest.
Wait, so if you're a non-bank, you have to file a lien just to auto-debit a payment?
In certain interpretations, yes. Imagine you're a small business needing 10 grand today. You go to a fintech app, but because they're a non-bank, they have to stop, file a UCC1 with the state, wait for it to clear.
That destroys the instant lending.
It completely erodes the value proposition. It adds friction, it adds cost, it slows everything down.
But if you are a bank,
you get a get-out-of-jail-free card. Texas HB 700 explicitly exempts banks and bank holding companies.
So by becoming a bank holding company, Enova just bypasses this entire mess.
Precisely. While their competitors are hiring armies of compliance officers and slowing down, Enova can continue business as usual. It's a massive regulatory moat.
That is huge. And it really contextualizes why they'd pay that 2.54 times book value. They're not just buying a bank, they're buying an exemption.
An exemption from friction. And the fit is good too. Grasshopper is a best banking as a service provider. Their tech stack is API driven.
So it plugs right into Enova's machine learning underwriting.
Correct. They plan to originate new small business and near prime loans through the bank, but the riskier stuff, like the CashNet USA brand.
That stays outside the bank, I assume.
Likely, yes. You don't want to pollute the charter with subprime reputation risk, but they still get the benefits of being a bank holding company. It's a best of both worlds structure.
And the market sentiment agrees. S&P revised their outlook to positive. Analysts are calling it transformational.
It validates the whole strategy. The market sees this isn't just about getting bigger, it's about getting safer and more profitable.
So it feels like the market has priced in the accretion, but have they priced in this strategic leverage?
I think they've priced in the spreadsheet benefits. I am not sure they have fully priced in the competitive devastation this causes for Enova's non-bank rivals.
Which leads us perfectly to our favorite segment of the show.
Let's do it.
Now, for the part where we throw out the disclaimers and pitch an outrageous but plausible trade idea, this is not financial advice.
Okay. I call this one the regulatory arbitrage long.
I'm listening. What's the setup?
The market is looking at this deal and saying, great, Enova lowers its cost of funds. That's the spreadsheet view. They are missing the existential hedge.
Okay, so how do we trade it?
You go long Enova, ticker ENVA, and you go short a basket of non-bank alternative lenders, the fintechs that don't have charters.
Walk me through the logic there.
Because the tide is rising. State regulations like Texas HB 700 are the trend, not an anomaly. Every time a new state passes a law like this, the non-bank compliance costs skyrocket. Their operational speed slows to a crawl.
Meanwhile, Enova is exempt.
Enova has the golden ticket. They bought immunity from this friction. So the spread between Enova's operating margin and a competitor's is going to widen significantly. You own the company with immunity. You short the ones getting bogged down in red tape.
And what about the Cantero risk? What if that makes things messy for national banks?
That is the outrageous kicker.
Yeah.
Let's say it does get messy. Enova is now a multi-billion-dollar entity with a bank balance sheet. They are large enough to fight those evidentiary hearings in court.
And the smaller fintechs.
They get crushed by the legal fees. They can't afford to litigate significant interference in 50 states. So even in a messy legal scenario, the big bank charter wins by attrition. You're not just buying a bank, you're buying a legal shield that decimates the competition.
That is ruthless and entirely plausible. It turns legal complexity into an alpha strategy.
That's the business. The friction is moving to the state level for non-banks. Enova just bought a hovercraft to float right over it.
So to wrap this up, Enova puts down $369 million. They secure a national charter / funding costs and effectively insulate themselves from this rising tide of state regulation.
That's the summary. Now we watch the clock. The regulatory approval is going to take 12 to 18 months. But if the Fed and the OCC approve this, it signals a new era. It tells the market that buying your way in is the only game in town for fintech.
And if you're a fintech CEO without a charter, you're probably looking at your strategy deck and sweating a little bit today.
Oh, absolutely. The moat just got wider.
Thanks for listening to Talk Tickers. Keep watching the tape.